Hello. In today's video, we gonna talk about how to make money investing in Facebook IPO. Facebook IPO is a big deal, and it's not just about making money. You've probably heard of Facebook, but do you know what an IPO is? I'm going to break it down for you in this video. An IPO is when a company goes public, which means shares are put on the stock market and anyone can buy them. The price per share depends on how many shares are being offered and the demand for them. You might be wondering how you make money from an IPO. Well, let's get started. What is IPO? IPO stands for Initial Public Offering. Think about a company that's been around for a long time. When the owners of the company want to get the word out about their products and services and make money by selling shares in the company, they go public by issuing an IPO. Going public means the company files with the SEC, the Securities and Exchange Commission, so the company's owners can offer to sell stocks in the company. In order for an IPO to be issued, the SEC requires a variety of information about the business, financial statements, ideas for company growth, and any other plans related to what the company hopes to do in the future. Why does a company decide to do an IPO? You might be curious about why a company that appears to be doing well would find it appealing to have an IPO and become listed on the stock market. Francis Gaskins of IPO Desktop provides these reasons. 1. To pay debts. Some companies go public to make more money. To pay off creditors. 2. For liquidity. Other companies choose to do an IPO when they desire cash to pay shareholders in the company. 3. To increase awareness of their products and services. Usually there's some publicity whenever a company goes public. You might hear about it on the television, national news, the front page of the newspaper, or the internet. 4. To expand their customer base. When the word gets out that a company is issuing an IPO, the general public becomes more interested in the company and may want to get in on the action. When more people are aware of the company will gain more customers, more money. 5. To obey laws governing companies. The SEC requires certain companies to go public if they reach a certain size. When company representatives weigh out all these factors, they are able to make the best decision about whether it's time to issue an IPO. Who buys stocks from an IPO? The very nature of IPOs makes the initial buying process available only to certain entities and individuals. 1. The company controls who has access to IPO stock. The company itself has complete control over how the initial stocks are made available and sold. Typically, the company turns to underwriters who establish terms and conditions to purchase initial shares and then make them available to other buyers. The underwriters receive instructions from the company's owner about how to price the stocks. Typically, underwriters focus on selling to financial institutions and large investors, mentioned in number 3 and number 4 below. 2. Company representatives are in a good position to get IPO stocks. They are usually given first options to buy. 3. Banks are often involved in IPOs. Banks who have done business with the company that's about to do an IPO often get first dibs to purchase the stocks. 4. Big money investors, because of their buying powers, can take advantage of IPOs. Individuals with lots of dollars to invest can often get in on an IPO. 5. Average Joes might have a slim chance to purchase from IPOs. On rare occasions, people who don't fit into the above categories purchase IPO stocks. See how to invest wisely in an IPO. As you can see, all kinds of people and entities can purchase stocks in IPOs. Even so, average individuals who want to invest small amounts of money might not have access to the process. How to invest wisely in an IPO? As mentioned above, it might be difficult for you to purchase stocks from an IPO. However, there are ways you may be able to take advantage of it. Consider these ideas on how you could go about wisely purchasing stocks from an initial public offering. 1. Have an active account at a brokerage. You must have an account with a brokerage firm in order to indicate interest in purchasing during an IPO. Also, Investment firms establish their own in-house rules about who they will and won't sell IPO stocks to. For example, your brokerage might require you to have a certain dollar amount in your account before allowing you to make IPO purchases. Also, the brokerage firm might even have rules about how soon you can resell stocks you purchased from an IPO. The brokerage could establish that it will only sell IPO stocks to you if you buy their premium, pricey services. So, keep these issues in mind when you're thinking about buying from an initial public offering. 2. Investigate the company yourself. What you're trying to determine is whether the company shows promise for explosive growth and change for the future. If you believe there are still possibilities for the company to offer more products and services that will be good moneymakers, it's a very good sign that you should try to get in on the IPO. 3. Consider the advice of experts. Be aware that financial experts are mixed on whether to invest in IPOs. Some financial gurus suggest stock prices will be at their lowest in an IPO, and you should definitely try to make your stock buy during the IPO. Other money experts say it's best to wait and not purchase during an IPO, because the stocks will most likely drop in value once they're trading in the aftermarket. Then, you can get more for your money. Aftermarket means after the IPO has occurred. 4. Call your stockbroker and ask for an indicator of interest. Your best bet, as soon as you hear any buzz about a company considering issuing an IPO, is to do your homework to see if you believe you'll make money on the stock. Then, if you think the stock would be a good addition to your portfolio, call your stockbroker and have him put in what's called an indicator of interest for you. He will approach the company that's about to do an IPO and let them know about your wish to purchase stocks. In the event you do get in on the IPO action, consider selling your stock soon after you purchase it to make the most money if the price is rising in the initial IPO frenzy. Keep in mind your brokerage may have restrictions about this, so check out those rules before you buy. Since the new stock could be of interest to many potential investors, they might clamor to buy the stock in the aftermarket, which will push the price up, which means more money for you. Understanding IPOs is one more way to educate yourself about finances. The more you understand about initial public offerings, the better the decision you can make regarding how to invest your. Thanks for watching. Please like the video and subscribe to the channel.